Welcome back, friends. So, global stock markets have achieved their most impressive first quarter performance in half a decade, driven by optimism surrounding a gentle economic slowdown in the United States and a fervor for AI or artificial intelligence. The MSCI index, encompassing stocks from around the globe, has surged by 7.7% this year, making it the strongest growth since 2019. Equities have notably outpaced bonds by the widest margin seen in any quarter since 2020, despite traders revising their projections for swift interest rate reductions. It was originally anticipated at 6 interest rate cuts in 2024. Now it's come down to just 3. The charge has been helped by the S&P 500, which has closed at a record high on 22 separate occasions during this first quarter of calendar year 2024. The AI boom has fueled the market's gains, with chip designer Nvidia adding more than $1 trillion in market capitalization during the first 3 months of the year, equivalent to about 1/5 of the total gain for global stock markets over that period. In the United States, signs of a resilient domestic growth have boosted stocks despite unexpected increases in inflation in January and February, which led investors to dial back expectations of as many as 6 interest rate cuts this year. So, seeing the rather robust January and February inflation data, expectations of interest rate cuts, as I mentioned, has reduced from 6 to 3. Nevertheless, you still have the stock market charging higher, even on the basis of or on the backdrop of such reduced interest rate expectations. So the markets now agree with US Federal Reserve's projection of 3.25% or 25 basis points cuts from the benchmark rate's current 23-year high. So what began as a tech-driven rally on Wall Street has gradually broadened out across the quarter, with equities even in Europe and Japan beginning to outpace the United States. In Europe, you find that bank shares are charging ahead like anything. You have Standard Chartered Bank zooming at this point of time. UK's FTSE 100, German's DAX, French CAC 40 and Spain's IBEX 35 all have outperformed the S&P 500 in the month of March 2024. As the breakneck pace of Wall Street's rally began has to ease, while the global indices, the sectors beyond technology, have caught up with earlier AI-driven gains in the United States. So now it's across the world. The equity market is getting very enthusiastic and embracing an all-out rally. Leading the pack among the major markets is Japan, where the growing confidence in the economy and rising prices for the domestic chip-related stocks have driven a 16.2% rally in the TOPIX in 2024, putting the index within touching distance of its all-time high, which it hit in the year 1989, before the Japanese stock markets went into a deep slumber. So all in all, so far we have achieved good disinflation without recession fears in the United States. How long that can last is anybody's conjecture. The stock market gains have come even as the government bond yields have risen, reflecting falling bond prices. About 2/3 of those polled for the Bank of America's latest Global Fund Manager survey do not expect a US recession over the next 12 months. This is up from just over 10% at the start of 2023. So you can see more and more bears are moving into the bullish camp. And that is a sign of a warning. For the first time in more than 2 years, the bulk of investors also expect the global corporate profits to grow over the medium term. Don't forget, we are about to start rolling out the results of Q1 of 2024. worldwide. So surging asset prices also reflect investors' growing appetite for risk. In a single day in January, Nvidia's market capitalization rose by about $277 billion, roughly equivalent to the market value of every listed company in the Philippines. A 60% rally over the past 3 months, meanwhile, has pushed the total value of existing Bitcoin above the gross domestic product or the GDP of about 150 countries. The risk so humongous has been the risk appetite. Similarly, substantive gains for other risky assets have prompted some to believe or to compare this rally with something which they have never seen before. And the words that are most commonly used are, "This time is different." So, I could say that when we hear these words, "this time is different," they begin to ring warning bells. Didn't we hear these same words at the time of the dot-com bubble? The AI boom is here to stay, but the rate of market capitalization growth is so phenomenal that it can just blow your thinking. You may not even realize, you may just blink and you find that Nvidia has once again shot through the roof. Friends, this is, whether this is hype, hysteria, or whether this is here to stay, is something that definitely time will tell. As far as my understanding of the situation goes, the artificial intelligence is definitely here to stay. There is going to be great increase in human productivity across the various frontiers, across sectors, across economies, and across the world. However, the market capitalization and the way the investors are scrambling for AI stocks and various other types of stocks in different parts of the world. In Europe, it's banking stocks. In Japan, it's the chip makers. In India, they are the PSUs, the public sector undertaking shares. All this and the valuations that are being attached are so out of sync with the fundamentals that the stock markets across the world, I believe, deserve a breather at this point of time. A breather which is something that may not happen tomorrow, but is coming so soon. It is coming sooner than you imagine. To get to know more, do join our Prime or Prime Plus Telegram groups, which addresses the specifics of the US stock markets. And to know more about the Indian markets, you can join the Premium Value group, which gives you full 1 week predictions in advance. Or you can join our special budget package, which gives you daily predictions of the market. And both have some very good stock recommendations as well. And you can do that by WhatsApping us on 982-086-1044. Happy investing and have a great investing week ahead. Take care. Bye-bye.